What's up, you guys? It's Henry. If we've learned anything about the stock market in 2020, is that it's entirely unpredictable in the short term. Though the broader market has conclusively shown that increases in value over the long run, stock market crashes and corrections are far more common than you may realize. In fact, since 1950, the benchmark S&P 500 has undergone 38 corrections of at least 10%. That's a correction on average every 1.8 years. Following the quickest rebound from a bear market low to fresh highs in history, it's certainly possible that another stock market crash could be in our near future. So in this video, I'm going to give you guys some real facts about a stock market crash and what you should be doing from all the research that I have been doing. And I'm gonna give you guys some industries that thrive during stock market crashes, especially because election is only 1 month away. Tomorrow, I will have 5 hideout stocks if we have volatility, so make sure you are subscribed with notifications on. The thing is, a stock market crash doesn't have to be a panic sell. Oh, Henry, I'm going to be selling all of my stocks. I'm going to be waiting for a further dip. Even if you're a highly conservative investor, there are better strategies than selling all of your stocks. I'm telling you guys, timing the market is better than timing the market because there is a lot of research backing up the claim that timing the market is better. But Henry, why should I stay in the market rather than time it? All right, my friend, I'll give you 3 reasons timing the market is better than timing the market. And number 1 reason is there is no such thing as having a crystal ball. I like how some people watch a specific YouTuber and trust that he is right about what stock will do what next. The truth is, no single person has a crystal ball and nearly nobody can consistently predict the stock market's next move. Stock prices are unpredictable. We do not know what is going to happen next, and even if they were predictable, it would still be impossible to make money on investments as the market price wouldn't budge from what everyone else has calculated to be the future price. If a financial advisor, the internet, or anyone else tries to tell you otherwise, be cautious. 2, it's an emotional roller coaster. People inherently want to keep track of their money, and this makes a lot of sense. So when it comes to investments, company stock prices and markets are fluctuating widely on a daily basis. A market timer may be tempted to sell their investment too quickly to capture a small profit or to avoid a loss, despite the fact that their original theories as to why the stock may grow haven't really changed. That's because finance and stocks are an emotional game, and we think by tracking and by making more decisions, we can make more money. For instance, since 1950, the S&P 500 has seen calendar year returns vary from 47% on the upside to 39% on the downside. This is where the human psychology component comes into play. If you got unlucky in 2008 trying to time the market, you were down 39%. It is very difficult, emotionally speaking, to reverse the course and try to time the market by buying. If you use the time to your advantage, market volatility starts to wash out. Looking at the same 1950 to 2017 period, but looking through the lens of a 5-year investment horizon, returns for the S&P 500 ranged from the lowest of the low of 3%, and I mean down 3%, up to 28%. Guys, again, even the worst 5-year period, you would have only been down 3%, which is much easier to stomach than a negative 39% in one single given year. This is known as the behavior gap. Author Carl Richard states, "We're wired to avoid pain and pursue pleasure and security. It feels right to sell when everyone around us is scared and buy when everyone is feeling great, but in fact, that is pretty much the opposite of what you should be doing. It may feel right, but it's not rational. Market timing easily plays on our emotions and gets in the way of serious investment analysis. If the reasons for your belief in a stock change, then it's important to be willing to change your investments. However, market timing easily tempts us to jump out too early or to stay in too long." For my $300,000 piece of paper, which I'm gonna be putting into a frame and bringing over on the channel because I wanna show you guys, basically that finance degree tells me, and I've learned, that smart investors, and I mean the real ones, not the Wall Street ones that can't wait for their quarterly bonuses, those real investors focus on their long-term financial goals. Again, tomorrow I will release a video of 5 safe stocks you can hold through an election and market crash. So make sure you are subscribed and like this video so you get notified of tomorrow's post. The next important thing to give you guys all an idea of what you can start thinking about, since we are 1 month away essentially from elections, is better industries to be invested in to protect your portfolios should the roof fall and people lose their minds. I have done research on industries, and here are the industries that best survived the last recession back in 2008. Number 1, we have discount retailers. The stock that beat all other S&P 500 stocks during 2008 was Dollar General, rising more than 60% that year, almost double the second highest returning stock. That isn't surprising if you think about it, because people need things still and they'd rather buy them as cheaply as possible. I would expect another discount retailer such as Walmart to perform very well. This makes intuitive sense as recessions reduce consumers' income. When consumers' incomes go down, they can either substitute cheaper goods or buy fewer items. Whoa, I'm back in economics class. That was my first time using a substitute on this channel. Since there is a minimum of how many staple goods like food and basic household supplies you need to buy, you can't just cut them out from your budget like you could with a new car or something like that. That means to save money on them, you will turn to cheaper alternatives. As a result, discount retailers are likely to do well in a recession. Number 2, healthcare. If you group together all the companies related to healthcare industry, there were 3 in the top 10, even more than the discount retailers, in fact. You need healthcare to live, and therefore you are much less likely to skimp out on it even when your income declines. That's why some of my closest friends are doctors, because they want high incomes and they always want in-demand jobs. The technical term for not skipping out on a good or service even when price increases is called price inelasticity. Inelasticity. You get what I'm saying, right? I was barely born in America. My first language was Russian. Not all healthcare companies are created equal, and recessions are likely to hurt those companies with more debt and less cash flow. So these enterprises have less ability to absorb losses and service their debt at the same time. Therefore, it may be smart to stick to healthcare stocks that have low debt to equity ratios and avoid biotechnology startups that are still in their early phases. I will cover debt to equity in the next video on this channel, and I will certainly give you guys a slam dunk healthcare stock as well. Last very interesting idea is DIY, which stands for do it yourself. Rather than paying someone else to do it, you would do it yourself to save money. The DIY and repair sector can thrive during a market crash or unstable economy. When times are tight, one way to cut costs is to repair what you own rather than replace it, and do routine maintenance yourself. That may be the reason for the strong 2008 performance from auto parts retailer AutoZone, ticker symbol AZO, and also from home and garden improvement retailers Tractor Supply Co. and Sherwin-Williams. During a recession, consumers are more likely to repair their cars rather than buy a new one, as well as do home improvements and garden work themselves, especially people who lost their jobs and now have more time to do things like this. With ongoing pandemic-related business closures, DIY activities may include even more industries this year. If you have any ideas, feel free to drop them down below. I try to read every single comment and respond to as many as I can. Here is the bottom line. The above list isn't exhaustive, as investing during an economic downturn is an enormous topic. Each downturn happens for a different reason, and it's hard to predict which reason will cause the next one. But having defensive stocks is especially important during election years, if you ask me. It's important to have both defensive and offense stocks in general, but it's especially important to have defensive stocks because there may be a lot of volatility in the next month or two. Anyways, make sure to take advantage of this information. As always, I love you guys, and I'll see you in the next video. Be aggressive in learning, but be safe in investing. Oh man, I almost forgot my fist pump.